Hey everybody, it's Brent here, and I got my good friend Imran back, and we're going to do a talk about the options expiration and volatility landscape on a day when the market's a little chippy. So, how are you doing, Imran?
Hey, Brent, how's it going?
I'm doing good, man. I got this new software, and Matt, who's co-founder of SpotGamma and it has all these sound effects in it, and so I was thinking of playing all these like really funny things, like, "Hey, Imran's here, everybody," and then I can play this. I don't know if you could hear
Oh, thank
that.
you.
I was gonna wait for you to make like your most serious point about volatility, like, you know, here's what's gonna happen, and then I was gonna play like a laugh track or something. But anyways, that's enough of that. Trying to keep it light. um, so it looks like everyone hopefully can hear us. I'm able to talk with everybody, and so first thing I have up here is this presentation, and we'll just use this as our slides for talking point. I was on the market huddle, which everyone should listen to, last Friday, and I talked about most of these slides in that presentation, but I really wanted to get your view on some of these points that we're talking about. With the market kind of sliding, it's weak, but it won't quite break down, right? It's bending, not breaking, and I think that's kind of interesting topic to hit on here. So. Before we launch on that, Imran, do you want to tell everyone just how to get a hold of your site? Because I know toward the end of the podcast, or excuse me, towards the end of the live, people may drift off a little bit. So,
Sure. Oh, yeah, sure. Thanks for that. Yeah, so I'm Imran Lakha. I run OptionInsight, which is a trading company. The purpose is to teach people how to trade options. I run boot camps. I run a service called Macro Insight, where I kind of give my color on a weekly basis to all my subscribers, talking about the markets, talking about how I'm trading them from a macro perspective, and using options and derivatives as well. Something that I do a lot of is crypto options. So I put videos on YouTube called Crypto Insight and Macro Insight, and you can also find me on Twitter at options_insight. That's my little quick plug. Thanks.
sweet. So, Imran and I have talked, I don't know, six or seven times now on these live platforms, and the feedback's been really great. So we're going to keep doing it until you guys get tired of us. But the first thing I really want to talk about, which I thought was interesting, especially given today, is that we have this issue where longer dated vol, it's not really an issue, but it's the topic du jour, is longer dated vol is quite high. So if you look at S&P options out 30, 60, 90 days, that vol is pretty high, implied vol is pretty high. Shorter dated implied vol going into this week was quite low. So it was a very steep curve, contango curve, right? So if we looked at the VIX interpretation of that, it looks something like this. And then what I've seen happen here in the last couple of days with this market weakness is that short-term implied vol has caught a bid. So now this, instead of having contango, we're a bit flat. Is that kind of what you're seeing? Do you kind of agree with that? You seen something different, or what's your opinion
Yeah,
there?
I mean, generally the way it works is the shorter dated skew is a lot steeper than the longer dated skew. So when you get these moves down, you do get a very quick flattening of the term structure. But also what you see is that doesn't persist for very long. So intraday you might see a proper flattening of the curve, and literally by the end of the close, where people come in and hedge their gamma or hedge their delta overnight that they're charming into, or whatever it is that triggers a bit of a rally, then that front end just collapses almost just as quickly. So you do structurally have this contango. There's a lot of reasons for it, like term premium and stuff like that. So it's never really very stable when it goes flat. But yeah, no surprise that you saw a bit of flattening recently as the market traded down. Yeah.
Yeah. And so I guess our view of that was, or at least I should say SpotGamma's view of that was simply that we get this idea, or we have this flow that comes in every day, particularly in the expiration days, and they sell short-dated S&P options. And so, we have some slides here that talk about that, and this shows that the SPXW, which is the weekly options, has very high volume and an escalating volume, right? The volume gets higher and higher and higher, particularly after the COVID crash. And SPX regular volume, which is the monthlies, and then also the spider volume has stayed very flat. So, in other words, short-dated SPX options volume going up. Now, the other point to that is that open interest has stayed flat across the board. So when you have short-dated volume increasing, but not an increase in open interest, that's saying that guys are coming in, trading short-term options, and they're day trades, right? They're in and out in the same day. and we think that's mostly vol sellers. How do you feel about that idea that our view is it's mostly call and put selling?
I mean, it might be vol sellers because vol sellers like to harvest their premium quickly, and so when you sell weeklies, those things are decaying pretty fast. But if there are people actually who are trading intraday, I would argue they may be opportunistically using the leverage that options give them to express a delta view, and they get in there. Like I did this exact trade yesterday, right? So the market sold off down to 44.50 with two hours to go before the close. I was thinking, okay, this level seems to be respected, and I think we're going to bounce into the close like we always tend to do. What can I buy as a cheapy option for that view?
Yeah.
And I bought the 44.60 calls, 10 ticks out, and they cost me 2 ticks. And
those are the next expirations that you chose?
No, they were the dailies. They were expiring the very same day.
Right. So you didn't go a couple days out.
Yeah. So I'm just saying, using really, really short dated options like that to express delta views gives you amazing leverage.
Mm-hmm.
And I think a lot of day trader types are doing those type of trades. And I think that might be partly explaining that explosion in volume, basically.
That's certainly, that's certainly quite possible. I think when I look at the gamma trade and I look at some of the intraday movements, I've grown to the feeling that it is a lot of selling, but you are 100% right, and I totally agree with you that if you want to try to make a big bet, buy cheap gamma right on a bet that the market's going to bottom on a day like yesterday or even today, that those very short dated options are.
I think you're right. The predominant flow is selling because that vol trades cheap, right? If the predominant flow on that stuff was buying, that vol would trade expensive, right? But you look at those super short dated a day to a few day expiries. You look at the break evens that they're giving you on those options. They're so low. That's what makes them so attractive as an opportunistic buyer like me. So I think you're right. I think the predominant flow is selling. It's depressing that vol in the front end in the weekly stuff. And if you are a day trader type and you're trying to opportunistically express a view, you can take advantage of that and buy these super cheap options as and when you think you've got strong conviction of a move, basically.
And those short dated options, they carry a higher implied vol, than, so if you look at just a monthly with 3 days left to expiration, those extra expirations do have a little bit more vig in them, I guess I would say. At least there's
but when you're talking super short dated, you can't think of it like vol. You think of it like break evens, basically, right? So that's the thing. And again, this is what I teach in my courses, right? Like super short dated options it's all about what's the break even of that option structure, right? Well, if I buy it here, where's the strike? Where's the break even? Where do I start making money, basically, right? When I'm trading 1 month or longer, then it's about implied vol. It's got some actual Vega on it, and then you've got a lot of other considerations of those other Greeks to worry about, basically.
Yeah, I would also say, I guess, that the shorter dated options they cost less premium, right? So it's more accessible to more traders. Like, there's a funny thing, like I don't want to spend $1,000 on an option that expires in a couple months to express my day trade because it's $1,000, even though that premium will still exist tomorrow, right? You'll still have it. But if I can buy today's option for 50 cents or $50 or whatever, it's like it is more.
Yeah, it's funny. It's a counterintuitive thing because, funnily enough, when you buy a weekly option, like all the retail traders love to do, that thing's decaying super fast.
Yes.
Right.
Yeah.
So it will lose 100% of its premium in a matter of days.
Yes.
Whereas if you had bought a 1 month option, the headline number's really high, but the decay's actually very low.
Right.
So it's completely counterintuitive, but you're absolutely right. The psychology of traders often is to say, what's the cheapest premium expression I can find? Even though that premium is going to die in 2 days, I'm going to do it anyway, right? Because it'll give me leverage and I don't spend too much money, right?
Yeah, and I also this reminds me of the meme squeezes, right? Where it would, like, the main stocks, GameStop or AMC, would get too expensive, like the $100 stock. Who can buy that, right? And they would roll down to these $5, $10 stocks. Like Wish and these other ones. It's easier to squeeze those because it costs a lot less and everyone can get in. I guess it's kind of a funny phenomenon there.
Yeah.
So I wanted to shift along this lines, which I think is one of the most interesting things that has really come around in terms of a trade idea. I saw this yesterday from this guy Purple 8 on Twitter, who I believe he's a SpotGamma subscriber. If he's not, I apologize. But this is a guy who knows his stuff. He's been around for a long time. He posted up this trade about a risk reversal where you could sell the 4,000 strike put in the S&P for December, and you could buy 20 of the 5,000 December call. So that's called a risk reversal, and that is basically just a very convex bet that we're going to get a big move higher in the market. And then along with that, just today I saw this interesting chart from Alpha X, which shows the skew of 5% out of the money put to a 5% out of the money call. It is extremely skewed, such that they said you could sell a 5% out of the money put and buy 18 5% out of the money calls, and I believe that was for the October is what they were looking at. So those two guys, Alpha X is a great podcast, by the way, by a guy, Dean Kernut, who has been in working at banks for a long time. He's actually a boss of mine for a very brief period 20 years ago as a segue. Anyways, but Imran, funny enough, you said you were talking to your group today about a similar trade.
Yeah, exactly right. I mean, so my general idea was that, it's quite well flagged now by a lot of banks, a lot of strategists, that a 5 to 10% correction is what everyone's calling for at some point between now and year end, right? There's a lot of known risks, a lot of known macro tailwinds there, headwinds, sorry. And so actually it's not going to surprise anyone if there is a sell-off, right? What's going to surprise people is that we actually don't get often go directly to 4,800 to 5,000, which is kind of like a sensible target zone.
Yeah.
If you project some of the Fibonacci ratios and stuff like that. That direct ascent to that level is probably going to surprise people. So the way to express that view makes a lot of sense. And I'm not surprised other people are calling it as well, because I spotted it last week and I said it to my subscribers. It's like, I was looking at November expiry, because the market often loves a rally into Thanksgiving, basically, right? Like into a holiday period. So I think the timing's right, because we might not actually get a real taper. Even if we get a taper announcement, we might not get a taper until December or later, okay? So into Thanksgiving, we may well still have the liquidity support, right? And you look at the November expiry, I was looking at the 4,200 puts, selling one of those to buy as many 4,800 calls as I could, and the ratio was looking roughly 12 to 1. So that was the trade that I was pitching to people in my Telegram group and saying, that does look like quite an attractive way. And you size it, even though you're selling puts, which can be dangerous, as long as you size it appropriately, that you're willing to take delivery of whatever amount of delta you buy at 4,200. You look at the chart, 4,200 would be quite a nice place for a correction to find some support. So saying that I'm willing to take delivery at 4,200 of an S&P long position into year end is probably fine. Yeah. And then you get the gearing and the leverage to own loads of those 4,800 calls. If you were to get an acceleration over the next month, you can make some pretty decent money off that.
It's a very, very convex structure, which, if the Fed comes out and says whatever magic words that make people happy, there's a lot of vol that can get sold off, and those structures could pay off, pretty dramatically.
Yeah, I mean, you don't want vol to get sold off too much, because if you rally into that strike, you're going to be long a lot of vol. But the good thing is that vol's already priced at like 10 or something, right? So how much lower is it going to go? It's more, you just need the rally to happen in the first month, ideally, where it's got some Greeks on it. It doesn't decay away too badly. So that's called a risky ratio. It's called a bullish risk reversal, because you're buying the call and selling the put. And it's a risky ratio because it's not 1-for-1, basically. So these are structures that have been around for a long time. Some institutions use them when they're underweight the market and they want to get some gearing to a rally just in case, as a bit of a hedge to an underweight. But yeah, they can make a lot of sense because of that convexity and the steep skew.
Yeah, it's a very good point about vol. I guess when I'm talking about, it's more the puts are going to get closed out and or burn up the line. There's a lot of puts, and so very very key point there.
That can fuel like delta buying through the Vanna and the charm effect, basically.
That's exactly
the market
right.
rally, basically. Yeah, exactly.
Right, but you're 100% right. You want that call vol to stick around and draw that up. So those are fascinating trades, and this is kind of interesting. I think a lot of people carry probably spider equity exposure anyways. I don't know, a few hundred shares of spiders or whatever it may be. And if you're going to be short the put, that risk looks the same as basically, or very similar to owning, so being short the put and long the stock can be a pretty similar risk profile. But you can actually trade the XSP minis just as an aside. Those are the mini SPX options. which don't carry their assignment risk. You don't have to worry about the dividends, but also has better tax treatment if that's something that's of concern for some of those people out there,
Interesting.
which can help out. So, and then I would also just say, as we kind of flip over to today's market, we have 50% of Gamma roughly is set to expire across the board. That's single stocks and options. There are a lot of put options that are set to expire in tech in particular. I saw a chart very quickly on XLK correlations. Some guy was trying to point out that basically all tech is moving with a very high correlation of like 1. And it's an interesting thing now because, like you mentioned before, that banks are putting out notes that things are so bearish. We put out this note last week saying that the market is positioned for a lot of high risk, and when people are expecting the crash, a lot of times it doesn't manifest, right? In that you can make an argument that it's a well hedged market now, and we're bending and not breaking at these levels. And like we put in our note this morning, as we get closer to expiration on Friday, puts are going to decay. That's that charm trade. Do you think that there's any chance we catch a bid before the FOMC? Is that something that can line up, or does it?
I mean, I get the feeling everyone keeps front running this expiry, right, and getting really bared up into the expiry now. So like we got a wobble last Friday, which is actually a week before expiry. I was thinking there was actually half a chance that might have been the expiry correction that we're used to seeing, because everything just happens early as people front run it, right? Now, in this case, you've got a bit of a special situation because you've got FOMC next Wednesday, and people might be a little bit nervous still, not want to be overly exposed to anything. So that will prevent people from getting too pulled up maybe, right? But yeah, I wouldn't be surprised that we get some sort of dovish surprise out of the FOMC, just because, the Fed speakers have been banging on about inflation, persistent inflation, right? What they were calling transitory. A lot of Fed speakers are coming out and saying, actually, we don't think it is. We think it's more persistent than transitory,
right?
And we think we should taper this year. So what the pattern with the Fed tends to be that a lot of the speakers throughout the month, they speak hawkish, get the market prepared and quite hawkish. And then Powell comes in and says, you know what, we'll wait a bit and see if Delta goes away, see what the data's like. So I think the Fed will probably, this is my personal view, I could be wrong, okay? It's not financial advice, obviously. But basically, I think a dovish surprise, given that Powell probably wants to keep the optionality to taper later if he needs to, if the economic recovery takes longer. Because you saw the labor market, right? The labor market disappointed with non-farms. We don't know what the September number is going to look like, but the trend doesn't look that great on non-farms right now. So I think they're going to want to keep some optionality, and I don't think they're necessarily going to announce anything in the meeting, and that might be taken as dovish, and that might trigger the bounce that we're talking about, basically.
Right. And that's a sneaky. I mean, I think that's the default bet to make, right? I think that the Fed. I mean, we don't cover macro really here, but in general, I find that I think the goal of these FOMC meetings is to do whatever is most stock market friendly. That's their barometer. If the market goes up the next day, then we did our thing, right? If the market tanks, and that's the Powell pivot and everything, and that's the dance. And with Kaplan day trading futures like that, you got to make sure that he's positioned the right way. So we talked about some interesting trades for the market kind of ripping. I mean, the risk reversal or the risk reversal ratio, depending on how you like to set that up, is, I think, probably the most interesting trade for the dovish surprise, right, or whatever gets the market going higher. But the tricky part here, I think, is trying to hedge the downside, right? If you think that the market could really break down, because vol is pretty high, it's expensive. I think that vol or puts that are positioned past the FOMC, they give you a little bit more time because the premium should hold up until after the Fed event, right? But the odds are that there's just going to be that the puts are just going to get destroyed really when Powell is done, right? So, what are the interesting ways that you could look at hedging downside?
Yeah, I totally agree that downside is a tough one. I mean, the easiest sort of, do not have to think about it too much, is just put spread trades, because we said the steeps already. We said the skew's already really steep, and so the way of taking advantage of a relatively low level of vol, which maybe, I'm not sure I can say we've got a low level of vol when we're realizing 7 or 8 and we're implied at, VIX is at 18, 19. So I'm not sure, but a lot of the VIX elevation is because skew is steep, not because vol is steep. So put spreads look reasonable in terms of the leverage and the payoff ratios that they give you. So October, November, December, pick your expiry based on how long you want your protection for. But put spreads look reasonable in times of, relatively low vol and very, very high skew. Right now, outside of that, it's a tough one. I mean, you could, if you've got a more specific view on like the sell-off and how fast it's going to happen, maybe put calendars where you own December puts and you sell maybe something in front of it, like maybe an October put in front of it, and you strike them to the downside. And the idea is if we start to roll over, we won't break the October put by October, but you'll be long that December put and you would have cheapened up your premium. But those things are a bit path dependent and are a bit tricky. So they're not a no-brainer, those trades, unfortunately, right? So tricky to hedge the downside. But maybe the best way to do it is to just do what you do and say, if we break the vol trigger, take my delta down. And then, because we're not in a safe environment, and then let the move play out. And then if things stabilize again, then get back in, basically, right? So rather than spending premium in anticipation for that move, maybe just use the levels that you guys have to know where the risk lies. And when we break those levels, just be prudent about it and go, okay, there's too much risk in the market right now, shut down. Right?
Yeah.
Maybe that might be a good way of doing it. Yeah.
Yeah, and that is actually an interesting point, because with those ratio risk reversals, right, you could be, let's just say very simply, like short 100 shares of SPY, right, and long one of those ratio risk reversals, and even in the market, if the market rips higher, initially your delta is going to get hurt, right, but that's going to catch up very, very quickly if it is an explosive move higher, right, and it gives you some time.
So you replace, the idea is that if you're bearish the market, then get out your exposures and replace it with the ratio risky, because that will cushion you for a drawdown down to 4,200. But if we get a direct rally, as long as the rally happens fast enough, you still got positive exposure, right? So you could think of it as a switch out of regular market exposure. If you are bearish, rather than adding an overlay to get bearish, get out of your exposure and replace it with this bullish risky, which gives you that convex payoff to the upside, but means you're only going to be long the market from 42, which is what, a 5% drawdown from here, basically, right?
Yeah.
So that might be a good way to do it.
Right. Yeah, that's a super interesting idea, and we've talked so many times before too about how much open interest sits at the 4,000 or 400 strike, both of those SPY and SPX, and in an Armageddon type scenario, I just think that there will be such a strong, bounce there that it's an interesting level to key off of. Which, when you flag these ratio trades, it's
yeah. I mean, there's one question I've got actually. I don't know if you've seen, the JP Morgan rolling put spread collar structure.
Yeah.
That been flagged by some guys on Twitter. I mean, I haven't seen anything this week about it, but that's expiring this Friday, right? So surely they're rolling.
Yeah, that's exactly right. And someone
been rolled yet?
I don't think it has been rolled, and a good friend of mine was talking about the fact that he believes that people have caught on to that trade, and so they may try to break it up and put it on over a few different days, or change the expiration around a little bit so it's a little less easier to detect. Now, I don't know if that's specific to that JP Morgan trade, but there's also the Gamma Hammer and some of these other ones where it's kind of like you say, like you don't want people to start kind of front running, so to speak, these trades, these movements. And well, I don't think you can front run that JP Morgan trade over a material amount of time. If that trade is going to get put on, I think that there could be some squirrely things that happen intraday, at least, that probably move prices against them a little bit. But I've not seen any movement on that trade.
But if that trade is happening this week, let's say, then that's going to be probably supplying December Vega to the street, and it's probably a net purchase of Delta, right? Because they would have gone through their call strike. The call strike will be a negative Delta, 100 Delta, and they'll be moving it into a put spread collar that's probably like more around 50, 60 Delta again, which makes it a net Delta buy. So a net Delta buy and a net Vega sale, which might help fuel this kind of bounce that we're talking about if they roll it this week. Right?
Yeah, I think I'll have to double check this. Maybe someone in the comments knows too. I think that those are the quarterly expirations though. So I think that trade would be for the 30th, I believe, not on the week.
30th of December.
No, I think the roll would happen on September 30th with the quarterly
Oh, I
expiration.
see. It wasn't okay. It wasn't third Friday September. It was actually end of
I
September. Yeah,
believe
you
that's
might
the
be right.
case. Oh no,
I
so
think you're right. I think
uh,
you're right.
yeah,
Yeah.
Sarit on the chat says it's scheduled to roll on Friday. So we'll have to double check that one and see
Okay.
what that's the case. And kind of interesting to this note, actually looking at the market here, the chart in real time, we've had this gamma inflection point that's shown up on our data for some time at this 4440 level, and we're sort of bouncing off of that line or that signal, and that shows us that the puts in the market structure kind of keeps getting rolled lower. But I believe we're also kind of right on those. Oh no, Sarit corrected himself. September 30th, he said now.
Yeah, I think that's right. I remember now that it was that. Yeah.
Yeah. So we'll give Sarit some applause here.
So we're gonna
I've been
we're
waiting to
gonna
push
see
those
that
buttons.
flow in the next couple of weeks, basically, right?
Yeah, so that flow should come on, and I also think those strikes are right around here, 44 and the 44.
Yeah, the call strike was a 44 handle for sure.
Yeah, so we'll have to kind of look those up and comment on those below. But one of the things I want to note is that we just saw with the market kind of hitting off this pink line here, which is a big support line, there was a very, very big positive delta trade that just hit kind of in the market. So those could have been probably a long call trade, could have been someone selling some puts, but this is an active area with that fund being positioned, and then obviously the next couple of days we have that options expiration. So, I think, and kind of what we put in our morning note is that volatility is really what's going to happen here, right? We might get a huge move up or a huge move down, but it seems like things are coiled. And actually, kind of also harkening back to what we talked about before, I think I could bring this chart up, is the idea that it's actually been a record number of days, some kind of record, since the market's had a 1% rally, actually. I believe it's been 39 days, which is pretty interesting. It almost seems like not possible that we haven't had a 1% rally in 39 days, but, it's this slow grind higher, but there's not a lot of volatility expressing itself to the upside, really.
Yeah, that is interesting. I mean, it feels like we're up all the time, so, you'd have thought you'd have more, but the rallies are in magnitude small, but in frequency high, basically, right? That's what we've got.
Yeah, and we just kind of, we continue to just keep grinding higher, is trying to find the easy way to bring up that post with that image on it. But I'll find that and try to post that later for everybody. So why don't we take a minute here? We'll look at some of the single stock exposures. If anyone has any of those, you want to put those in the comments, and Imran and I can kind of give a couple ideas or thoughts about what's happening on those single stocks. Imran, I know you
AMC? What do you think at AMC?
AMC is the one that's kind of interesting. We did this data release, which just analyzed the stock movement. The stock's down at 48 right now. Is that right?
Is it?
Double check that. It seems like it's down quite a bit then.
Yeah, it's been hanging around the 50 level, hasn't it?
So the interesting thing is that we found that what happens is most of the movement in AMC is overnight. So it catches a bid in the wee hours of the morning, and then what typically happens is it'll open at or near the highs and then fade. So it has extremely high movement, like intraday vols, like it'll move on a 12% range intraday, and then the sum of it all is that on a closing basis, it only typically moves about 1%. So there's a tremendous amount of intraday movement in the stock, and then it really doesn't move a whole lot actually at the end of the day, which to me just screams gamma, right? Because that trade loves these big swings and then just closes flat. You can sort of.
So I've got a trade on in AMC. If you want me to.
Yeah, I would love to hear it, so I can take the other side. But
thanks.
No, I'm kidding.
So no, I started entering this a couple of weeks ago as we were squeezing back up again when we went back through 40 to 45, 48. And basically, I did a put spread collar where I bought an October expiry 40 strike, 40 25 strike put spread. So along the put spread, and I sold the 70 strike call against it. And that structure was pretty low premium. It cost about $1.50 to potentially make $15 if we collapse back down to 25 by October expiry. And the idea was I was trying to take advantage of the squeeze in the stock, which I didn't think was going to be sustainable. And the volatility was really elevated and really high, obviously, as it has been in AMC for a long time. So the put spread collar is a way to sell vol and sell delta, right?
Yeah.
Since then, I mean, it hasn't really gone anywhere since then. I mean, it's carried on grinding a bit higher, but since then I've bought back my 25 strike puts to leave myself with just a risk reversal now,
Nice.
where I'm long the 40 puts and I'm short the 70 calls. So that's it. I'm just pretty. Maybe this will be famous last words, but I'm pretty confident that we're going to struggle to break 70 on the upside, given that that company is just a basket case in terms of money burning.
Yeah.
It's not like a tech stock. It's not like a tech stock burning money, right? You can be a unicorn, you can burn cash, but because you're a growth name, your stock can rally. But this stock's rallying, and this it's like cinemas, for crying out loud, right? Cinemas. I don't believe that these valuations can hold, and so I think taking advantage of those upside wings that are too expensive to own downside, I think it's quite a decent trade, to be honest.
Yeah, and as far as the fundamentals go, on the face of it, I agree. I mean, there's tons of people who I think are positioned in this thing because they think they have some inside information of some, not inside information, that's not the right term. They have some, they believe they have this insight into the way the position is structured that they can really squeeze some other people out through illegal short selling or bond melting or whatever else they want to call it. And I think at the end of the day, you're right in that in time these things will drift back down, and it takes a lot longer, than a lot of people would expect. I mean, the stock has had one heck of a return. I love selling puts on this thing because I just think it will take so long to come down. And the nice thing about the puts is you have a lower bound there, right? The stock can go to zero. It's not likely, but if they are ever right about the infinity squeeze in your short a call, I mean, odds are I think you're right. We're not going to see over 70%.
So I think
but
I get that, and I agree with that, and I think that's why when you are short calls on a name like this, you got to monitor what the borrow cost looks like.
mm-hmm.
So if the borrow starts going crazy, or if the implied vol on the upside just goes nuts, then you got to respond and just say, okay, it's too risky.
Yeah.
But if you look at the implied vol, it's not 600 anymore, right? It's come down a lot. It's like back in the 130, 140 region, having gone way, way higher. So telling you that things aren't quite as stressed as they were in terms of implieds. So because imagine you're a guy who's massively short, right? If the borrow starts going crazy, you're gonna have to cover that short, or you could buy call options on the stock against your short to basically protect yourself.
Right.
And that would make the implied vol on the calls explode as
Right.
well. And we're not really seeing such a major explosion in implied now. So I'm watching it. Like I say, I'm not going to be stubborn. If it starts going through 60 in a meaningful acceleration, I'll just bite the bullet and cut it. And that's why I've not done big size anyway.
Right.
Because you just got to size yourself carefully with these type of unlimited loss type structures. But I still favor it's probably an okay trade to have.
I'm not disagreeing with you that it's a selling that calls can be because those calls are expensive, and so there's a pretty good amount of income. And I've also found that based on this day we rolled that we could sell the at the money flies. And what's so interesting about that is that typically what I've seen is the at the money fly $5 wide fly will get $3-4. So you're almost getting a 10% yield to sell the at the money fly that's only 5 days out. So even if you're long the stock, you can be long the stock and sell the fly against it. And what do you have, $2 of risk? So you still catch the infinity squeeze if it ever happens, but you're almost generating a 5, 6, 7% yield over the week if that fly is correct. And the other thing to note here, 55% of gamma we show expires on the 17th. So most of that is at 50. Those are all calls that are likely burning up now, right, and leaning on this stock. It is just a very large expiration that's lining up for Friday. Apple, let's see, Tesla. So we'll take a quick look at Tesla here. That is a stock that typically does pin large gamma areas pretty well. The big area right now that we see is at 700. Again, 50% of gamma expires Friday. And the stock's at 743 right now. It's had a pretty strong last few weeks, really. I don't know why, because the fundamental story, I don't think, again, has improved all that much. But granted, I have not paid a ton of attention to it. But I think 700 is a big magnet for that stock. Again, flies may be interesting over the next couple of days. That is a pretty big move to drop down 5% or so. Do you have any view on Tesla or any positions in there?
No, I mean, I saw Elon was basically saying that he thought the company's overvalued. He cracked me up. He cracks me up with some of his nonsense that he tweets, right? But it's like, are you trying to buy a dip in your own stock or something? Like, what are you trying to do by saying stuff like that? He's like saying that companies, they're giving the company a very generous valuation or something. But yeah, I mean, again, Tesla's one of these where for choice, you probably want to be selling strength. Gun to my head, but it's not one that I've got a position in right now, to be honest.
Yeah, and if you look at our metrics, they're shifting lower. So that we had most of the game at 750, and that's now moved down to 700. And the amount of gamma sort of that's set to expire is picking up. So that tells me that the positions are building lower, not necessarily higher in the name, which probably, which again, gun to head, just sort of glancing at it pretty quickly, would say that lower is probably a little higher odds of a move lower than up is kind of, if I had to guess. Quick question on Apple here, and then Paul's asking about Netflix, so we'll check those two out, and then we will. Then we can give it a brush. So Apple has been weak. We have most of our levels at 150. Again, 38% of the game expires on Friday. The stock has had a lot of negative delta flow, I'll say, from our intraday options metrics. And what I think is interesting mostly about Apple is that I think it's a lot of long stockholders that sell calls against it. And so I think that the gamma positioning, when we use our gamma model, which tends to favor dealers being long calls and short puts, I think that's probably true in Apple. I think there's a lot of people that collar essentially their Apple stock position.
That makes sense.
All right, here, last one we will check out is Netflix. This stock has had, it was up quite a bit, I believe, and now it's really faded back quite a bit. Yeah, so we launched on August 18th. Up until last week, we had moved from basically up $100 in the stock, so really quite a big move, and that move is fading pretty hard here, which is interesting. As far as our metrics go, if I let's just search for Netflix, not Influx, and then I'll get some data here.
I'm not seeing it at $100.
No, I'm saying it was up $100.
Okay.
The stock moved from 510 in the middle of August up to 610 last week, and now it's fading off of that level quite a bit.
I had a pretty dramatic rally the middle of August,
Yeah, really incredible move there. It was probably off earnings, I would suppose. So again, 40% of gamma is expiring on Friday. So someone just asked in here, what is the significance of a lot of gamma expiring? So if you believe that options are a driver of stock prices, pinning or of momentum or whatever you believe it might be on the impact of options, when big options positions expire, we believe that the hedging flows that are tied to those options will also change and adjust. So that means that dealers can adjust their hedges, which could create some volatility in the stock, and also people are likely to roll their options positions, right? New strikes come in, and that will have a big impact or a push on the dynamic of the stock. So we've done a lot of studies on this. Just to give you an idea, if there's a lot of puts in a name, for instance, we did a study on this, I believe it was in Intel a few months ago, where after earnings, the earnings were bad, and there was just a ton of put options in the name, and the stock could not catch a bid. And as soon as those put options expired, the week after, the stock, ripped and rallied back. So these big gamma positions tell us when big options positions are expiring, and that can cause a lot of adjustments or shifts in the stock. So in Netflix specifically, there's a lot of gamma position in around 600. So I personally might lean on that as a top for the name. It's not too far under that level. The market is weak, obviously. So from a beta perspective, a lot of these big tech stocks, can get leaned on and get swung around by big movement in the market. And actually, one quick question here, maybe we could kind of close after this, is do you ever look at using single stocks as your hedge instead of trading? So in other words, if vol or puts are too expensive in S&P, right, would you ever look at using single stocks to get that down?
It's funny you say that, because I've got a podcast that I'm launching. I'm gonna have to get you on it, actually. I'm launching a podcast on Friday, and the first episode was with a guy who's a long short portfolio manager, and he does exactly that, right? So he occasionally has a bit of VIX in his portfolio when it's cheap enough. But when it's not, he quite likes using concentrated short positions in names that he just thinks are disgusting and completely the wrong price, because he thinks in a broad market drawdown, they will get disproportionately punished compared to the broader market. So that's how he likes to have his kind of hedge on, because you can have a situation where if you turn out to actually be right, that those names are just the wrong price, you might get a broader market rallying, which you're exposed to, and then those names still go down because they're just too expensive. So that's a win-win. But the idea is that in a broad market negative sentiment type scenario, some of these super high value names that don't have the fundamentals behind them will get disproportionately punished, right? And so I sympathize with that view and how he uses those, and that's why he's very short AMC, and he thinks stocks like Tesla, stocks like, you know, some of these meme names are good candidates for those type of names that will get punished disproportionately in a proper real broad market sell-off. We're not talking about 2-3% correction. We're talking about a 20% type move. Those names will get destroyed, basically. That's the idea.
Yeah, that can make a lot of sense. So you get the drawdown from the beta trade essentially, and then there's also just the fundamental aspects of the company being weaker that might accelerate kind of in that drawdown.
Yeah, because they're very sentiment-driven names, right? Like the meme names are all sentiment, no fundamentals. So when we go into a bear market type phase, sentiment evaporates, right?
Yeah.
So the guys who are pumping up these stocks, who aren't buying it for a fundamental reason, they disappear because they've either already blown up their capital because they're small guys or whatever. That sentiment-driven bid goes away, and then there's no one else left to buy those names, right? And they crash. And you look at some of these stocks like Wish and stuff that were meme names that were like, you know, at $15. Where are they now, right? Like mid-single digits, they've been annihilated, and the market's higher, right? So they've been punished for not having great fundamentals, basically, right? So
yeah, and a lot of them are, you know, a lot of stocks are they're energy trades, right? People focus on them, capital flows in, and they can't squeeze them anymore. So there's no reason to own them other than simply we're trying to squeeze them, right? And
yeah, it's the hot potato, isn't it?
Yeah. Actually, you know, I would say that the last topic, but one thing I want to bring up, VIX expiration tomorrow morning, right? So today's kind of your last day before the close to settle your VIX. Kevin brought that up. It's a great on the chat there. Do you have any views of sort of how what effects VIX expiration tomorrow may have on markets or vol sort of in general?
No, to be honest, no. I mean, I've moved on from my September VIX position now. I was long it over the last sort of month. I was kind of holding a bit of a VIX position, and I was underwriting it with some S&P vanilla options.
Yeah.
I thought the VIX would hold up well because it contained these events like FOMC and stuff like that. I've now moved on. I'm kind of eyeballing October now as a short side of a trade. So I'm looking for entries to get short the October contract into a spike that we might get into FOMC, because I think then we'll get a nice vol reset and that will go back. So right now the October's at 21.5. I think it trades sub 20 within a week or two, provided the FOMC is not a shocker. So that's kind of the trade I'm looking at. But for the expiry, I don't tend to really run it into expiry because I don't really have the insight that I think you need to call which way that print's going to go, basically, right? Leave that to the market makers and the guys who see the VIX flows. I'd rather leave that to them because they have the information advantage, I'd say.
Right, and that's an excellent point. I mean, we don't ever sort of offer an opinion on what the VIX trade is going to do to the market. If for those of you who don't know, the VIX is based on the price of S&P index options that are 30 days to expiration or less. And you can actually see big strips sometimes of VIX, of SPX options print in sort of correlation to the way that the VIX will move. There's a few articles or news items you can read in terms of manipulation of VIX using S&P options. They'll kind of give you some insight on how the trade used to work. They're not supposed to do that trade anymore. I don't know if it happens, but anyways, you can trade strips of SPX options and hypothetically move the VIX around. So sometimes those trades can take place. But because of the link between the S&P 500 and the VIX, anytime you have a big expiration taking place, we had someone ask about the window of weakness opening tomorrow, that this is an opportunity for vol to creep in, right? Maybe that means it ratchets the market up or it could sell it down. But anytime things are getting expired and rolled in big portion, and whether it's single stocks or index, we think that can really spark movement in a break in sort of the status quo of the market, which we've been seeing over the last few days.
Yeah, I mean, what you often see with VIX expiry, in my experience, is you get a sell-off in vol into the VIX expiry. And we're not really seeing that right now. If anything, we're seeing the opposite. We're seeing a bit of a sell-off in the market, and we're seeing vol trade up into the expiry. So normally when you see an extreme sell-off in the VIX into the VIX expiry, that often marks a bit of a short-term low in vol, and vol actually had a bounce, right? Because all the selling has kind of culminated into that expiry. I think it's a bit like the opposite is happening right now, where you've got a bit of nervousness going into this one. We've had a pop in the VIX. The market's weak. It might stay weak for a couple more days, but like I said, I think the opportunity set is now coming from the opposite side, is to sell into a VIX spike, or maybe this already is the spike. But I think the opportunity for October VIX is definitely on the sell side. That's how
It's really quite fascinating as we're looking at the real-time chart of VIX here. You know, we're at 1970, and yesterday we hit highs of 21, and the market is at or, you know, kind of beneath those levels, certainly pushing those levels. So, you know, the relative high in vol, the VIX specifically, is not really coming, which gives you an interesting indication of what vol is doing. Vol is not breaking out, and if there was surging put demand here, the VIX would be spiking, right?
Which is telling you that the market has digested this move down now. It's not in as vulnerable a position, and if we don't break your vol trigger down at 44.20-ish, then the market's probably comfortable, right? And the VIX doesn't need to spike. So I would say that's kind of how, if you're going to lean long now, you probably use that vol trigger you guys have got at 44.20 or something. Use that as your stop, because that's when vol might then have another ratchet higher, basically, right? But if we can kind of stay above there, the vol's telling you that even going back to the lows in spot over the last couple of days, the vol's not reaching new highs. It's telling you that the street's a bit more comfortable with its positioning.
That's a very eloquent way to put it. So thanks. And with that vol trigger, that's kind of our gamma flip line. And I think if we break that level, which is right around 44.25, that's where the dealers start shorting, and that's sort of, you know, where things can really spill out, right? Because in here, I think the gamma is pretty flat. Vol sellers aren't really coming out, and we're just kind of really drifting around, you know, inside of this range, as opposed to having that reflexive, you know, buy the dip move where we shoot right back up to, you know, 4,500. So it is quite an interesting dynamic. So, you know, Imran, if you have anything else to add, you know, if not,
no, that's it. I mean, like this time, like I said, this time yesterday, I was buying one-day call options on the S&P because I thought there would be some buying into the close. I'm watching again to see if that's what we're going to get, right? I mean, I imagine the pricing's pretty similar. Looking at the dailies, I use a platform in the UK called IG, so you can trade these dailies quite liquidly and quite easily. So yeah, like the 44.60 calls right now, again, cost about 2 ticks. If we get a bounce to 44.70 in the close like we did yesterday, that becomes a five bagger basically, right? So those opportunities that 2 hours before the close just keep presenting themselves. If we're in that dynamic,
very good point.
Day, and then we're getting a reversion into the close because the gamma hedges who are long gamma are coming in later in the day, right? Because think about it, people who are short gamma, you're saying gamma is about neutral right now in terms of positioning. So you've got some shorts and some longs, right? If you're short gamma, you're not necessarily just sitting on your hands and waiting till the end of the day to hedge it. So you might be the one who's selling, pushing the market down to neutralize your delta. The guy who's long gamma on the other side of you is sitting there loving it. But by the end of the day, he's going to come in and buy his delta back. And that's going to turn the market round. And that's going to take things back up. So I think the timing on that may well be in the last 2 hours. Certainly that's what it looked like yesterday. Maybe we see it again today. If we see it again today, then that's probably confirming that that's what's going on under the hood, basically.
Yeah, and I would add to that I think the most important time for market makers and dealers to hedge is into the close, right? Because everyone needs to have their risk squared away for the 4 o'clock or 4:15 close. But I think that trade in particular is even stronger on the expiration days, right? Because there's so many same-day options traders. All those positions are going to close and expire right at the bell. So, you know, there's a lot of jockeying and adjustment there. People don't want to be assigned or have the position on, you know, to go through settlement and the whole thing. So that's a very good point, and great insight there. So, Imran, you want to give one more chance for people to let people know? I know there were some questions about your Twitter handle, for example, and your site.
Sure, yeah. I'm at options_insight on Twitter. My website is www.options-insight.com, and, you know, feel free to kind of contact me. There's an email there as well for inquiries. You can book a 15-minute consultation to have a chat, talk about your options trading experience, what you want to get out of our education programs, things like that. So yeah, feel free to DM me on Twitter as well if you want.
Great. And as far as SpotGamma goes, we have a free 5-day trial of our SpotGamma service that will give you access to all of our daily notes, our equity hub. We just launched our Discord channel. We got several hundred people in there. They're exchanging ideas all day long. And if we didn't get to your stock today in the chat, pop into Discord after. Maybe we can either we can share some thoughts on it, or certainly some of our other members can. And we really, most importantly, want to thank everyone for taking the time here to watch you and I chat for a little while. And so with that, I'm going to give you the DJ air horn and say, have a good day, everybody.
Thanks a lot, man. See you next time.
See ya.